Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And we're starting off this week on a slightly, I would say, concerned tone across the board with respect to what we saw over the weekend in the Chinese markets, the regulations there that have caused quite a bit of a panic selling over in China and some of the Chinese tech shares. And whether or not that's spilling over here into the U.S. and kind of the concerns that investors have, those are some of the things we're going to discuss here this morning. Now, before we get started, what we're going to discuss is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off by taking a look at the equity indices as we normally do. And there's quite a bit of, I would say, concern that I have right now with the major equity indices and where they currently sit. The things that we've discussed here over the past few weeks, many of those concerns have come back after improving slightly over the past couple of weeks. Then we'll take a look at the fixed income markets and what we're seeing from there. We'll show you some of the commodity markets, the sector rotation model, the economic indicators, and then our ideas here for today. But overall, what we want to take a look at is taking a look at kind of the whether or not what we're starting to see is some of the risks with China spilling over here into the U.S. equity markets. There certainly seems to be some evidence of that. So my name is Tony Zhang. I'm the chief strategist here at Options Play, and I want to share with you my technical research, my economic research, and the ideas that we have here looking at the broader markets. So over the weekend, we saw China publish some new regulations around technology and education, basically saying that education should not be for profit. And we see some of the major technology education shares like EDU basically tank overnight, dropping almost 60–70% over the last couple of trading days. So we saw that move, a big move happen yesterday, and we're seeing a continuation of that here today. Now, the one thing I will say is that the Chinese regulators that have stepped in, this all started with Alibaba going, with Alipay going public. This is a trend that has been in place for quite some time now. This is not new. As you can see, this stock was a $20 stock back here in February. When the news came out, this was already a $6 stock. So we're talking about a stock that had already eroded, a good 70% of its value before the news came out. And the news over the weekend was really kind of the nail on the coffin. And we see the same thing across the board with a lot of these Chinese stocks. If you look at Alibaba, if you look at JD, you look at Baidu, you look at any of these tech stocks, this has been in a very strong move here to the downside for quite some time now before the news here yesterday. But we certainly have seen the news here yesterday continue to sour the mood across the board for Chinese equities. Even we're seeing it in Chinese bonds now. So the question is really, do we see this spill over here to the U.S.? Now, largely, when you look at the markets here yesterday, the U.S. equity markets have been extremely resilient. After the Chinese markets are down 3–4% on the day, the U.S. equity markets managed to end the day at new all-time highs. So what we have to take a look at here is on the U.S. side, we are still in a very strong bullish market here, both on the daily and weekly charts. But the one thing is that the daily charts are back near the top end of the channel. So we've discussed this channel here over the past few weeks. We're near the back end of the channel. The top end of the channel, which generally favors more moves to the downside rather than continuations to the upside. As you can see, every time we hit the top of the channel, these are opportunities to see these quick 2–3 day pullbacks here to the bottom of the channel, and those moves to the bottom of the channel have been better buying opportunities. But I still want to continue to show investors here, one of the biggest concerns that I have is that as we push to new higher highs, momentum no longer confirmed these new highs. We're seeing this mostly on the daily chart. We're also seeing it some on the weekly chart. As we continue to push higher highs, we're not seeing confirmations from momentum indicators on those new highs. The story is roughly the same here for QQQ as we make new highs, very much still in a bullish trend here on both the S&P 500 and the NASDAQ 100. But as we continue to make new highs in price, as you can see, momentum no longer confirming these new highs, both on daily and weekly time frames. This type of divergence it's a tough one because it's not like you typically see this divergence and it's a good signal go out there and short the markets, because I can point out many other times where we diverged and the markets see a small correction and then they just continue moving higher. That's not to say that this can't happen again. We could see another correction, 3%, and the market continues to move higher. But the longer this goes on for and the more time frames it goes on for, the more likely you get a bigger and more violent pullback at some point. So this is really where you have to be diligent and be aware of these things and understand that these are better opportunities instead of adding to new positions, but actually taking profits on your positions that have been doing well. Especially your long tech stocks, your long positions that you have that are trading near all-time highs. The more divergence you see, the more likely this is a better time to take profits, to use strategies like selling cover calls, selling credit spreads, collecting premium, so that if you do see some acceleration here to the downside, like you see, like we're starting to see in Chinese stocks, then at least you have premium that you can utilize to go out there and potentially buy some premium, buy some puts, buy downside protection for your portfolio. Because when we look at the S&P 500 and you look at the Qs, while very much in a bullish trend, clearly have some of these alarm bells sounding off. And then when you look across the board to the other equity indices, if you look at the Russell 2000, Russell 2000 very much still in this range-bound consolidation range, recently getting rejected the 21-day moving average and potentially heading back towards to trade near that 210 support level here, failing to get all the way back up to the 230, 232.5 resistance level, which is what you would expect the minimum of as equity markets push to new all-time highs. You would like to see these push at least to the resistance levels and then potentially higher to confirm those highs, but we're not seeing that from small caps. We're seeing momentum on small caps continue to decline, continue to trade fairly poorly here as the rest of the markets continue to push to new all-time highs. The one slight improvement that we do see this week has been on the Dow Jones Industrial Index. The Dow Jones Industrial Index has now, yesterday, just shy of a new all-time high. So this is potentially confirming what we're seeing in the S&P 500 and the QQQ. But this could very well fail at this top and fail to make a new all-time high and continue to trade lower. So the Dow improved a little bit here this week. But when you look at across the board, if you look at it on balance, the RSP, the equal weight S&P 500 index, still has failed to make a new high since that May 5th high here. So as the S&P 500 and the Dow and the NASDAQ continues to climb higher, the equal weight index has not made a new high since the beginning of May. That is not constructive. What that's telling us is that the vast majority of the S&P 500 names is not participating on this move. What we're seeing is really just the major market cap names. The top 5 names account for, on the S&P 500 about 25% of the index. The top 5 names account for about 50% of the NASDAQ 100 index. Those top 5 names are the ones that are dragging the markets higher or dragging the equity indices higher. But the majority of the market is not participating on that rally, and that is not healthy for a market rally. You want to see all stocks participating. And if you look at RSP from November to basically May, the RSP was participating in these rallies. That was healthy until it stopped doing that. And that's when we're starting to see the health of the market continue to degrade since the beginning of May. And another indicator, some of you may have seen indicators like this or seen similar indicators, the percentage of stocks trading above its 50-day moving average is currently sitting at just 36%. If you were looking at a metric like this, you would not think that the equity indices were at all-time highs, the S&P 500 and the NASDAQ 100, yet only 35%, 36% of stocks are trading above its 50-day moving average. This just tells you how skewed those few dominant mega cap names have skewed equity indices to look like things are very healthy, to look like things are doing very well. But in reality, underneath the surface, underneath the hood, most of the stocks in the S&P 500 are not participating in this rally. That is evidence that the market rally that we're seeing right now is simply unhealthy. Now, that in itself, just being able to identify this does not mean that it's a great time to go out there and short the markets, because these conditions can go on for quite some time, and they have gone on for quite some time since May. Since the beginning of May, we've been identifying it, but that doesn't mean that it's a good idea to start shorting the markets in May. You would have lost money if you were trying to do that. So this is really where you want to, again, take the time to sell cover calls, thinking about moving to cash in some of your positions that are doing very well, thinking about raising some income that you can utilize to potentially buy some puts when the catalyst kind of emerges that breaks the camel's back, if you will. Is that catalyst going to be Chinese regulation? I don't think so, but it could be if this spills over even more. But you need some kind of spark. You need a catalyst in order to drive that market lower here. So that's kind of what we're waiting for. You can take some shorts. I'm not saying you can't short the markets, but you have to be very selective. You have to look at stocks perhaps that are a little overbought, that are overextended, that have that higher probability of pullback here. Those are the ones that you want to take a look at. But I wouldn't go out there and short, turn your whole portfolio short here based on these indicators. These are just alarm bells. These are kind of like, smoke detectors telling you that something is wrong, but that doesn't mean that there's an outright fire just yet. So keep these things in mind as you use these metrics. And if we look at the fixed income markets, we have seen a substantial decline here in the 10-year yield. It's really has consolidated, I would say, a bit around the 125 basis point level. After reaching 125, it bounced all the way up to 145, went all the way down to about 112 or so, and now we've consolidated around this 125 level. So the yields have seemingly found a bit of a equilibrium here around 125. The question is, what's next? And we really should take a look at bonds and how they're currently trading. If you look at TLT, after forming this bottom around 135, 136 or so, we really have seen a pretty strong move here to the upside in terms of bonds, and we're very much still in this uptrend, and this uptrend is still very much intact despite the big move we saw here last week fade very quickly. Could this break lower and start to reverse the trend here for TLT? That very well could happen, but as of right now, this trend is still very much intact, and bonds are continuing to trade higher here, so yields are still continuing to be compressed here. But like I said, we're finding a little bit of an equilibrium here around this 148 or so here on TLT, and the question is just to see whether or not, like for example, this 21-day moving average will hold or not, or if we start to see a break below that. If we start to see a break below that, then we can perhaps start to see yields move higher. If yields move higher, that certainly is also going to be a concern here for equities. As yields go higher, valuations come lower. We also see the dollar index form a bit of a double top here around this $93 level here or so. So if dollar continues to head lower here, which it hasn't yet, but if we start to see that, we could start to see commodities start to rise again, gold, silver, even Bitcoin, some of these other assets, if this double top holds and we start to see this roll over here a bit. And we certainly see some divergence here in the dollar index here as well. As we make higher highs in price, we have seen momentum confirm or fail to confirm those new highs. So seeing the same type of negative divergence here in the dollar index as we do here in US equities. And the question that I've still, that we've received quite a bit here over the past couple of weeks has been around Bitcoin and our views here. And from my perspective, Bitcoin is very much entrenched in this sideways $30,000, $40,000 range. And there's right now, there's not a lot of evidence that's breaking one way or another. You know, you've had multiple tests of 40,000, it's been holding, multiple tests of 30,000, and that's been holding. So very much this is a range-bound market here. Yesterday, we saw Bitcoin touch 40,000 very briefly, rejected off of that very, very quickly. So what we're really looking for is a meaningful break in one direction or another. You know, there certainly seems to be some momentum gathering for, you know, potentially bigger retailers taking a Bitcoin, such as Amazon. You know, if something like that were to happen, that would certainly be a huge move, in my opinion, for the legitimacy, if you will, of Bitcoin as a form of currency or a form of payment, but we're not quite there yet. But that is the type of news catalyst or news event that I could see that would drive Bitcoin out of this range to the upside, or, you know, perhaps down to the out of this range if, let's say, that doesn't materialize and we just kind of stay in this limbo here for quite some time. So taking a look at this sector rotation. So this is really something that we've also talked about here for quite a few weeks. And I've discussed the fact that since pretty much the beginning of May, we have seen a lack of sector rotation. It's the same conversation we're seeing in terms of lack of participation in stocks as they continue to move higher, or at least the major indices continue to move higher. What we're seeing is the major dominant names move higher while the rest of the market is being left behind. Mostly technology, mostly discretionary. And a couple of weeks ago, we started to see that shift a little. We started to see technology weaken. We started to see financials, industrials, materials, staples, real estate, all of these sectors start to gather some strength and start to improve on momentum. So we were saying that perhaps, you know, over the past 4 or 5 weeks, as things looked weak, things are starting to improve. But over the past week or so, that's reversed again. We're seeing the same level of complacency in the markets. We're seeing the same lack of rotation. We're seeing the same lack of participation by companies in this particular rally. And the sector rotation, you know, the stocks, the sectors that we were starting to see, you know, performance in terms of moving towards the leading category, they're all starting to slip. Industrial, materials, financials, industrials, real estate starting to slip here. And the ones that were leading in technology, consumer discretionary, healthcare are still moving back towards leading. So really a lack of rotation that we're continuing to see here in the broader markets. And again, that in itself is not particularly healthy for the markets. So the one thing I do want to point out to a few sectors that I think are worth paying attention to, consumer discretionary, one of the strongest sectors throughout the recovery phase since the pandemic, pretty much since you know, the beginning of the year, the weekly chart, as we make higher highs in price, the weekly chart has no longer confirmed those higher highs. And we're starting to see also the same on the daily time frame here as well. Higher highs in price yesterday, no longer confirming that here on the daily chart. So we're seeing kind of this negative divergence across multiple time frames, and that is slightly more powerful than just seeing negative divergence on itself, is when you see that on multiple time frames. This could be potentially a signal that we are starting to see a bit of a top here on both technology as well as discretionary. What we're seeing is the same thing here. As you can see, technology, higher highs in price over the past few weeks, no longer confirming those higher highs in terms of momentum. So both technology and discretionary, very similar price action that we're starting to see here. And on the flip side, we are starting to see a bit of a base here form in some of the weaker sectors like XLI. So we could start to see a little bit more rotation going forward here. That is potentially on the cards, but this is really something that is still emerging and we're still continuing to watch here over the past few weeks, and we'll continue to monitor here going forward. So taking a look at some of the economic data that recently just came out, housing. One of the strongest trades throughout the pandemic and even over the past few months, we're starting to see some of the numbers around housing ease quite a bit. And this is likely going to cause some reduction in terms of the price appreciation that we've seen here in terms of housing. But home sales have started to decline quite a bit here as as home prices continue to rise. And also at the same time, we've seen home inventories rise a third month in a row. So this is starting to ease some of the inventory constraints. A lot of the price appreciation we saw last year was due to very low inventory levels, well below multi-year trends here. But as you can see right now, where we're starting to emerge is inventory levels that are starting to become a lot better. And that's going to, like I said, ease some of the price appreciation or some of the strain that we've seen here in housing. So this could potentially lead to what I would consider the end, if you will, of the housing trade at the moment, unless these indicators really start to reverse lower or start to reverse the other way, where inventory levels drop, home sales start to rise here again. But as this trend continues for a third month here in a row, I would say this puts at risk some of those housing stocks. So for those of you that have housing stocks, housing home construction stocks, this is really some of the evidence that shows that that is starting to ease. So looking at some of the ideas here for today, this was a tough one, to find ideas in this type of market condition where you are near an all-time high. You've identified that markets are not particularly healthy. How do you position for this? I don't think it's a good idea to outright to go short the markets, because these conditions in itself does not mean that the markets are going to tumble. It just provides the potential evidence that things could start to accelerate here to the downside. And at the same time, you have to respect the fact that we're very much in a bullish market. We're not in a bearish market. It's not like those Chinese stocks that have been trending lower here for months. We're very much trending upwards to the right. So finding stocks that, strong fundamental stocks that are somewhat oversold is really the type of stock that you want to look for if you're looking for bullish positions. And then you really want to find very overextended stocks that are no longer growing revenues, no longer growing earnings. Those are the ones that have the highest potential for short. So those are some of the ones that I've identified here for today. So the first one here is Citigroup, especially as yields find a little bit of equilibrium, find a little bit of footing, and you think that yields could start to rise here, especially as inflation still is fairly persistent here, and our expectation is that the Fed will likely start to raise rates here sometime in next year. And some of the stocks that will continue to perform well in an economic recovery are mostly the major banks. And Citigroup, while one of the strongest major banks actually, has taken quite a bit of a tumble here over the past couple of months, from that $80 all-time high down to that $65 here or so. So our expectation is that if you look at the stock here, what we're seeing is that the opposite of what we're seeing in equity indices, where as the price continues to make lower lows, we're no longer confirming those lower lows by momentum. We're actually seeing higher lows on momentum. This is what we call positive divergence. It acts as kind of the inverse of what we're seeing here in the equity markets, and this increases the probability of a potential continuation higher here as we see lower lows in price, higher lows in momentum. This has the opportunity of a potential revisit back towards that $80 level here. So if you look at the financials, you look at Morgan Stanley and JP Morgan trading near all-time highs, maybe just recently making a new all-time high, versus Citigroup, very similar bank, but having this oversold feature gives you the risk-reward ratios that are a little bit more favorable to the upside, rather than chasing stocks that are at all-time highs here at the moment. And then two stocks that I do want to point out here that have the opposite view here. You have a stock like Costco, which has been performing very well here since the March lows. This is a stock that ran from 310 to 423. And if you look at the business, there's really not a whole lot that has changed. Revenue is not growing. Profit margins on this type of stock is pretty low here. We're not seeing a lot of revenue growth. We're not seeing a lot of EPS growth here. And we're seeing, for the weekly chart here, quite a bit of oversold conditions that we're overbought conditions, both on the daily and weekly chart here. So you just have, statistically a higher probability of a bit of a pullback here, especially when you don't have a company that has the fundamentals that, will grow at 20-30% revenue growth here, or continue that 20 to 30% revenue growth here going forward. So especially as you see revenue growth decelerate, as you see earnings are not actually growing here for this type of stock, and you're wondering, why does this stock trade currently? Why did the stock rally from 310 to 423? This certainly seems to have decoupled a bit, if you will, from the fundamentals. Those are the stocks that I look for a potential opportunity here to check back, if you will, to reality. But seeing some of that overextended with divergence here in a name like Costco, and then a similar type name, ROKU, technology name, as we continue to identify those negative divergences in both discretionary and technology. That's why we're looking at Costco and ROKU. ROKU forming a bit of a double top formation here, revisiting the highs that we saw here in February. This is another company that very similarly, is not seeing revenue growth, is actually seeing some revenue decline here. It does report earnings soon, and that could be the catalyst that drives this potentially higher here, but this also very well could be, a bit of a return back towards that $400 equilibrium here. It's had a very strong move here after breaking out above 400. Had the breakout, came back to retest it, and very quickly traded all the way back up to that all-time high. So is this a bit of a buy the rumor, sell the news on earnings? That's my hunch, especially as you look at stocks like this, where as it continues to make higher highs in price, no longer confirming those higher highs in divergence, and we're seeing the same thing here on a daily and weekly chart. So whenever I see divergence on multiple time frames here, that does provide a little bit more validity to this type of trade setup and trade signal that we're currently seeing here in the broader markets. So with that, that covers what I wanted to share with you here today. There's been a lot of developments here in the markets here over the past week, over the last weekend or so. Pay attention to what's happening. But like I said, what we've seen here in China over the past weekend is not new. This has been in place for weeks on end and for months on end. So this should not come as a surprise. It hasn't spilled over to the U.S. equity markets yet. It may, but I don't necessarily think that it's going to necessarily cause a huge contagion here, in my opinion, to the U.S. markets. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.